This is your pilot speaking. I regret to inform you that we will be delayed on the runway for another 3.5 hours. I've advised the flight attendants to drop off an extra bag of pretzels for each of you, and I'm going to ask that you please keep your arms closed and your armpits covered so that your neighbor does not have to smell you in this hot sun as you bake on a Las Vegas runway. Additionally, thank you for flying with Spirit Airlines, and just remember, this is exactly what you paid for when you got a $40 ticket.
Hey, if you are worried about having experience similar to this when you're getting a mortgage, well, you've come to the right place, because on today's show, my partner Christian and I are going to be explaining the difference between retail lenders, mortgage brokers, and portfolio lenders, and how you can make sure that you pick the right plane, buy the right ticket, and get the right airline for your specific journey. If you want to fly first class, if you want to fly private, or if you want the discount option, there's something for everyone, and we're going to jump into what's right for who today. And speaking of getting the right deal, Christian, tell me more about Deal Machine.
At Deal Machine, they provide powerful tools for real estate investors to find and close off-market real estate deals, manage their business, and achieve financial freedom. In fact, their app has helped over 150,000 investors in their real estate journey, earning a rating of 4.8 stars and over 5,000 reviews. Whether you're still looking for your first deal or you have a thriving real estate business, their app is built to make real estate simple. Find and add properties, contact the owner in seconds, automate your marketing, and more. Try Deal Machine today at dealmachine.com/BPYouTube and jumpstart your investing journey.
Welcome, Christian, back to Mortgage Monday. Let's get right into this thing. Today, we are going to be talking about mortgage options. You've got a retail option, a broker option, and a portfolio lender. And today, people are going to learn what those words actually mean. They get thrown around. But before we do, can you briefly explain what loan origination means?
Yeah, origination, I mean, not to answer your question with what you asked, but it means originating loan, right? It's the idea of taking somebody from a pre-approval, right? So somebody who's just had their income and finances pre-checked, right? And then actually taking you through the guidelines of whatever loan product you're pursuing. Like David, you mentioned, there's a lot of different options, and actually closing a loan, right? So, and it takes a loan originator, in other words, a loan officer, to do that, regarding licenses in many states and a lot of different training and resources they have to go through in order to properly walk somebody through that process.
So in essence, what's happening is whoever your loan officer is creating the loan package and then delivering that to the person who's going to fund it to save them the time and effort of qualifying the borrower and making sure that they are meeting the standards of the loan. Is that correct?
Correct.
Right. And that's usually something that is done either from a neutral third party, someone who comes together and originates that loan for the lender, or the lender may have people that work in their actual company that do this for them. But this is the majority of the work that's done when you're talking to your loan officer or your LO. When they're asking you for documents and statements and information, this is part of the loan origination process. Now, there's three main ways this is done. There's retail lenders, there's brokers, and there's portfolio lenders. Can you start off by explaining what a retail lender is?
Retail banks are pretty much what most people think of when they think of, I'm going to go get a loan, right? They think of walking into Chase, walking to Wells Fargo, walking into your local credit union, walking into the place that otherwise maintains your financial situation, right? Whether that's your checking account, your savings account, all of those things, right? And while it is true, many banks are also not just depository institutions, but lending institutions. That just means they provide financing. Not every bank does, and most banks are limited based on what they can provide. For instance, if you walk into Chase or Wells Fargo, they can give you a conventional or FHA loan. That's typically what they offer. Right? So retail is just a fancy way of saying it's direct to consumer. There's no third-party loan officers. There's no third-party underwriting, third-party processing. There's nobody else that's outside of their bank. We usually use the analogy of Costco versus your local supermarket. You walk into, I'm in Southern California, we have like Ralph's and Vaughn's, right? Northern California, I know, has Safeway. Wherever you are in the country, right? I know there's a lot of individual local supermarkets. That's retail, right? You go there and you get like a Ralph's piece of bread, Ralph's, branded stuff, all that. But you go to Costco, and that's typically a compilation of Costco buying in bulk and providing it to you, right? And that's kind of retail versus broker.
Okay, so retail lending, what are the pros and what are the cons?
Yeah, pros are you're going to be working with someone that you may recognize, right? So your banker managing your checking account, your savings account. You also have a direct local branch there, right? Which is nice. You can walk into your bank and ask questions. The cons are, like I said earlier, is that they're going to be limited in what they can offer you. They also may be a little bit more expensive, right? When you think of a bank, they have a little bit more overhead than someone like a broker would have, right? Chase has a location on every street corner, right? I mean, they have to pay their manager and they have to pay for, all the utilities of everything. And while Chase has a lot of different income sources. Typically, retail banks on average, now I don't want to just blanket statement this, but on average, typically retail bank loans are more expensive on a general basis than if you do go through the broker channel.
Yeah, and that's because, like you mentioned earlier, if you go to Costco, you're buying in bulk. They sell a lot of the products, so they can sell it cheaper. But if you run into 7-Eleven, you're paying for the convenience. I've used this example before. It's often with turnkey providers, so you're usually going to pay more for that house because you're getting convenience versus you buy a fixer-upper and you do the bird, you get it at a better price.
Yeah, and the way that I had this explained to me, it didn't really make sense why, the broker is a third party, doesn't have to be more expensive to pay for that third party. I know that's a question that a lot of people have. But the answer is, if a bank gets one of, let's just say myself as a client, right? We're a high volume brokerage. If a bank gets me as a client, they don't have to do any advertising. They don't have to pay loan officers. They don't have to pay processors. They don't have utility charges to hold our office open. All of those expenses are wiped out. And think of all that marketing that we generate, but we're doing it ourselves, right? And then we're bringing the business to the bank so they can cut so much of that bottom line off and provide savings in regards to that, right? And on top of that, when I bring them a loan, I typically, if they do a good job for us, we'll bring them 100 loans, 200 loans, 300 loans. Whereas if you're an individual buyer and you walk in, even if you're a really experienced investor, you're probably not closing 300 loans with your bank, right? That's the difference. When they go retail, they know they're getting one client, maybe for 1 to 5 deals. Whereas if they get a broker, you're talking potentially hundreds or thousands of loans, right?
So that leads us into the broker model. So to sum up the retail, the perks are that you maybe get to work with someone it's Karen from Chase, and you see her every time you walk in and you say hi and you feel comfortable. Also, maybe that bank has their own underwriter. So Karen gets to work with the same underwriter every time versus the broker model, which we'll talk about. You're probably shopping at different banks, so you're working with different people. But the bank doesn't have to give you the best price there is because it's like a layup. You just come walking in, they say, here's what our product is. They're going to make a higher margin. And then they also have to pay Karen. So Karen's salary is sort of baked into the loan you're doing, and she's not doing a lot of loans. So the loan has to be more expensive to pay for her. Now, you mentioned the broker model, which is a little bit more like Costco. And I know that's because brokers can sort of originate a loan and then shop it to as many different lenders as they have a relationship with. It could be 5, it could be 50. Can you explain how the broker model works? And then we'll dive into the pros and cons.
I had it incorrectly described, and somebody basically asked me, are you guys like the Kayak of lending, right? And Kayak goes to Expedia and American Airlines and everyone, basically just gets you pricing. If a broker's good, that's not what they should be doing, right? They're not just a price fetcher. What they are doing is that they're getting appointed and knowledgeable about all these different loan products to catch situations where you could qualify for a loan where otherwise you wouldn't be able to. Their goal is to go out and learn and just be a sponge and get bank A. Okay, cool. You got good rates conventional, but you have slow turn times, right? So that may mean if we have a really strict loan contingency or like a 10-day escrow, I can't use them, even if they're the best priced.
You'll lose the whole deal.
You may lose the entire deal, correct? And that's our job in making sure, that's the equivalent of Kayak saying they're jumping on, American Airlines seats and checking the seat quality, right? And making sure it's going to be a comfortable flight. Like Kayak's not doing that. They're just giving you price, right?
So you talk to the client. The client's like, hey, I got some money. I want to make sure I have a comfortable flight. You're going to put them on Hawaiian. Big planes, really fun people, lots of leg room. You're going to pay more, but you're going to be comfortable versus, you know what? I'm adventurous. I'm wild at heart. I'm willing to go cheap. And you're like, okay, we'll do Spirit Airlines as long as all these things could go wrong. Are you okay with that? And the client says, yeah, I could take a 60-day escrow to get through this thing. Spirit may be the best option. Now, what a lot of people I think get taken advantage of is when they're shopping lenders and they say, what's your rate? Well, they quote you the Spirit Airlines rate, but they don't tell you that you're going to get a Spirit Airlines experience, right? They quote it as if you're going to get a Hawaiian experience, but get the Spirit rate. What's something that people should be leery of when they're shopping brokers?
I think brokers that do volume, and obviously that's hard to validate. If you get referred to a broker by a friend or a realtor, typically it means they've had a good experience, right? So to be perfectly honest with everybody listening, you can go to the most experienced, perfect broker in the world and have a bad experience. You can. It's possible. Brokers are human too. We mess up. But on a grand scheme of things, you can decrease the likelihood of your 60-day escrows, of your uncomfortable airplane seats, of your, Spirit service on a Hawaiian flight. You can decrease those options by just avoiding, quote unquote, the Spirit Airlines, right? If there's a broker that has had good reputation, that is providing value, that you like your intro call with them, chances are are things are going to go better with that broker or lender. I mean, this could be your local bank, right? I mean, whoever it is, a lot of times that initial conversation can go a long way into clarifying who it is I'm working with, right?
So when you're shopping at brokers, you will usually get a better rate because they're able to shop you and a bunch of other people like you to the same lender. So that lender says, hey, if we want to earn Christian's business, we have to give his clients the better rate, versus the retail lender doesn't really have to do that. So that's why they're usually going to be a little more expensive. What are some things that people should ask the loan officer in the first phone call to make sure that they're not working with someone that's too expensive or inexperienced or only has 2 options as opposed to 20?
I think the first question should be, what loan do you recommend for me? I can't tell you how many times somebody has reached out to us for a DSCR loan, but they qualify conventionally, right? Just because you heard it on a podcast doesn't mean that's the loan for you, right? I mean, that means that if you qualify conventionally, it is objectively speaking a better loan product, right? It's a 30-year fix still, it's a lower interest rate, it's lower fees, and it doesn't have a prepayment penalty. Conventional is better if you qualify. DSCR is the next best option if you don't. If you go to a bank to get a conventional and they say, sorry, you're not approved for a conventional, they can't do anything else for you, whereas a broker could pivot you to DSCR or bank statement financing or no doc primary or all these other options. So number one, a bank or a lender or broker, whoever, who understands your situation and can pinpoint a loan product that is the best fit for you, not just try to get a one-size-fits-all loan.
Good. So they have to have a suite of products and then a knowledge of those products and then get the information from you to match you with the correct one, versus just letting you tell them, I want a DSCR loan. Okay, I'll go get that. Well, your rate might have been a point higher than it needed to be because you heard someone say DSCR on a podcast, as opposed to explaining to them, here's my situation, and letting them say to you, well, here's what would work. I think that's a great point. Whenever you're working with a professional at all, some property manager somewhere, you don't want the person that's going to do whatever you say. And I know that's counterintuitive, but you don't want a person that acts like a waiter. Get me a Coke. Okay, I'll go get you a Coke, right? What if Pepsi was on sale? Or what if you order the ribeye, but they had a bone-in ribeye that was even less money on special they didn't tell you about? You want the person who asks you the questions. What are you looking for? What kind of properties are you looking to buy? How often are you looking to buy? Tell me about your job and your debt to income ratio. That then knows about you and thinks, ooh, I have this lender that's super cheap, but they have long-term turn times, but you said this is an off-market opportunity. The seller's going to let you have more time, or this is a property with a high days on market, so the listing agent's probably going to grant you an extension because they just need to get it sold. We could go with the cheaper option versus, oh, you got a deal under contract. There's 10 other people that want it. You've got 12 days to get loan approval. We're going to have to go with these people that are really fast, but they're a little bit more expensive. The rate's a little higher. But in general, you want the person that's explaining your options, not letting you tell them, this is what I want, because you shouldn't be more intelligent and experienced than the professional you're hiring to do the job, right?
100%. Yeah, I couldn't have said it better myself.
Yeah, that's a bad case when you're smarter than the person who's working on your deal. Your ego loves it, but your checking account probably won't. And that brings us to the last option, which is a portfolio lender. People hear about this all the time. What is a portfolio lender?
There's 2 main things that portfolios mean in the industry. A lot of people think a portfolio loan is a loan that just covers a portfolio of properties. We call that a blanket loan. Unfortunately, a lot of people do also call it a portfolio loan. But a portfolio lender just means that the loans that lender gives out stay on their profit and loss. And all that means is that they keep them in-house. So for instance, if they have $100 million that they're planning to lend out, they're going to lend out, $1 million at a time, 100 times over, and they're going to keep those loans on their books, which basically just means you're paying them every month and their income is what they're making on that interest. Right? Not every lender does that. A lot of times they'll give you a loan, you'll pay them for a couple months, and then you'll get a notice of transfer of loan. That means they went and took their loan and sold it to somebody else. That's how banks really make their money, is because they make a little margin when they sell them. And then whatever the buying entity is, whether it's the mortgage-backed security market or the third-party market with non-QM loans, there's kind of a myth in the industry that you can avoid that. Even portfolio lenders can sell their loans off, right? Because their portfolio loan doesn't mean they portfolio everything, right? It means they can make a decision like, hey, it's time to sell this loan. We need to liquidate, right? It happens all the time. And portfolio lenders can be both through the retail market. So a lot of times these are local credit unions and small community banks. They'll usually keep stuff on their portfolio. And we also have portfolio lenders via the broker market. So if you go to a broker, it's possible we could place you with a portfolio lender. It just depends, right? Is that the best loan for you? Once again, there's no objective benefit of a portfolio lender outside of they may have a lower likelihood of selling your loan, and they may have a little more flexibility in terms because they don't sell to another lender that's going to be checking their underwriting, right? Right?
Yeah, and that's really where you hear about it the most often is people only mention portfolio lenders when they had a loan product or an exception that somebody else wouldn't have. So like for me, I used to have to look for these because I had more than 10 properties and nobody would give me a conventional loan when I had more than 10. So my only option was to go to a person that was going to hold it on their portfolio because there was a Fannie Mae, Freddie Mac guideline that said you can't have more than 10 finance properties. So when I wanted to get my 11th, they're like, sorry, can't buy. And that's where that whole myth came up in the industry that like you can't get more than 10. You can't get more than 10 conventional investment properties when you have 10 that are financed. You can still get a primary residence and you can now use other loan products like you mentioned, the DSCR and some of the other things that are there. But I would have to find a lender who said, we're going to hold David's loan on our books. We're not going to sell it to anyone else because then that 10 house rule didn't matter because the person buying it didn't care because there was nobody buying it. So maybe you get a portfolio lender who says, hey, we'll give you a super sweet rate or we'll give you lower closing costs or we have a lower credit standard or something like that because they're not going to sell it to somebody else. Usually though, it comes with a catch. In most cases, if they're going to give you a benefit like that, it's because they want something from you. They want you to have a certificate of deposit with them in their bank. They want you to keep a certain amount of money in reserves with their bank. That was the way I worked it out. I was like, hey, if you give me this loan, I'll put $100,000 in a certificate of deposit that you can hold for 3 years. So now they go to the board. They're like, hey, normally we wouldn't do a loan for this guy, but if we can get $100,000 CD at this interest rate, maybe we'll make it work. And so I kind of had a bargain with them. Is that still what you see in today's market?
Definitely less so. And I would say because what that sector of the industry used to be, right? You had to go to portfolio to get these little one-off exceptions. Now these one-off exceptions have become an entire industry. This is the non-QM lending world, right? Like the DSCR loan didn't used to exist, right? That was like you had to find some small bank that was willing to lend on the cash flow of the property and really underwrite it commercially, right? Historically, the way that commercial properties have been underwritten, but use that for a residential property. And you're right, 10, 15 years ago, that was all that you had. You had to go convince a small community lender to do that. Now there's an industry. So now these banks that historically were portfolio lenders who were like breaking the rules to lend on their own, now there's a whole community of them and they buy and sell loans to each other. So they've kind of created like Fannie Mae 2.0. So when you hear of portfolio lender, that's fine. It just means it's non-QM, but they may sell it to another portfolio lender.
And QM, what does QM mean, Christian?
QM is a qualified mortgage. It basically means it follows whether it's Fannie or
conventional
Freddie
guidelines. Yeah.
Correct. Yeah. QM is another way of saying conventional loan. But yeah, now there's this whole world of these portfolio lenders that have kind of created a subsector of, hey, we can buy and sell these to each other because everybody likes them. Right? Like a lot of lenders love DSCR loans right now. So they're not bad loans. They're just more ways to get a property financed. Right? When otherwise you wouldn't have been able to.
So the pro of a portfolio lender is they may have options to allow a person in a unique situation that doesn't qualify for other mortgages. You might make it work with a portfolio lender. The con would be if you go to a portfolio lender directly, they're not going to have a suite of products. It's going to be like, this is what we got.
Yeah.
You want the chicken noodle or the clam chowder? Maybe just the chicken noodle with the soup du jour, right? This is all you got.
The loan of the day.
The loan of the day. So they're not going to have a lot of different options, which makes me think that's usually the last option. When you can't get a loan anywhere else, that's probably where you end up. So when it comes to the different pros and cons of each loan, let's sum it up with this. Who's the person that should ideally be going to a retail lender?
We advise people all the time to go to small local banks and credit unions, who I refer to as local lenders, who are looking for small balance loans. So sub 100, 150K sometimes loan balances, only because nationwide lenders don't always like that loan amount.
Which is what you get at a broker. They're going to shop to a nationwide lender. So they either don't have a small balance loan or it's really expensive if they're going to do it, right?
Yeah. And that's in our example, if we're doing a $50,000 loan, it's too expensive to make it worth it,
yes.
Right? I don't want to charge that. A local credit union would love that though. Another one is land loans, right? So a lot of credit unions will loan on land because they just love their area and they want to invest in the county, right? But other than that, I think everybody should be at least starting their discussion at a broker.
What about some of the people that talk about a doctor's loan or a nurse's loan, some of these special programs?
There's some still around now. Those were the loans that kind of got pulled during COVID.
But would they find those at a retail lender?
Possibly. I know a lot of retail lenders that just don't even offer that anymore. But yes, if there is so that's a good example. A niche product that maybe you're like, I know a Schools First credit union, they have a really good teacher's loan. That's something that they have in-house. It's specific to them. Like if you come to us, we may be able to compete with it because maybe they're doing some stuff with their interest rate. But if it's something specifically catered to you and your industry, take advantage of that, right? Typically, they're only one-time use in their first-time homebuyer loans. So like, don't plan on building a portfolio off of them. But niche products, small balance, land loans are places where retail banks are going to be really good.
Kind of like when Target's having a sale on one very specific TV that's better than you get anywhere else. Hey, if they're going to have it, go get that TV, but don't expect to buy every TV you ever want at Target because they're not known for having the cheapest TVs. All right. Now, who should be going to a mortgage broker?
I think this is people looking for guidance, people looking for maybe helping lay out the bricks of their road that they're going to walk, right? Help them kind of create their roadmap of how they want to finance multiple properties. Someone looking to grow and scale a portfolio, or someone just looking to see what options are, right? And this could be anything from a first-time home buyer to someone with 50 properties. Getting advice and guidance onto the best loan fit for you. And then even if you go to a broker and say, hey, your best option is a conventional loan. And then if you go ask retail banks about conventional loans, that's one way to do things, right? But I recommend if you're looking to build a relationship, brokers are typically the best ones to do it with because they will be able to grow and scale their products as your portfolio grows, right? And that's what other banks don't use a lender that you can outgrow, and you'll never be able to outgrow a broker.
What about pricing? If somebody's trying to get the best interest rate they can, but they don't want to compromise service, is the broker the better option or is the retail lender?
On general terms, broker loans are on average cheaper.
Okay.
Now, specific products, that isn't always the case. For instance, we talked about small balance loans. We're not going to be the cheapest loan for $100,000. We're just not.
Which is why we'd refer someone to a retail lender.
Right.
You know what? You just reminded me, same for high balance loans at certain points in the industry. So during COVID, no one wanted to touch jumbo loans. This was a big problem because in the Bay Area, most of our loans were higher than a conventional loan balance would support. And so all of the jumbo loans that we were doing, either they wouldn't do them or they became insanely expensive. And so we would have to start referring them to credit unions who were doing jumbo loans because their prices are way better because they wanted that person with the high net worth to bank with them. So everyone started going there. And then when the COVID crisis ended, all of a sudden they were more expensive than us. So I did notice that there were certain times in like cycles in the industry where retail could be cheaper than a broker depending on what the strategy of the bank is. But overall, like you said, brokers are going to be cheaper because they've got the wholesale model as opposed to the 7-Eleven convenient model.
And that varies a lot. You see price jockeying all the time. You'll see a credit union slamming us one day and the next day we're beating them by 2 points. It's so wild. With retail banks, they're a little more, I see them pivot a lot more, whereas wholesale banks, the wholesale world is like they all know what each other's prices are. So they all have to stay somewhat competitive.
Yeah,
right.
That's
like
true.
If, UWM, one of our lenders, and then if Loan Store, somebody, if they get too far out of whack, nobody's going to do loans with UWM. If Loan Store is beating them by 3 points on a loan, right? Because all the brokers have access to both. So the wholesale market's much more, static.
A retail bank usually doesn't have as much money to lend as a huge bank who's buying 400 loans at a time from somebody like us, like a broker, right?
Yeah.
So Costco's got this huge store. They can throw something in the back corner, and if it's not selling well, big deal. They just leave it there till eventually someone buys it. They don't have to make it expensive to make up for the stuff that's not selling. That's kind of how the brokers work versus the 7-Eleven that only has a tiny amount of space. They're going to have to charge a lot more to make up for something if it's not selling very well.
Yeah.
That's part, like retail lenders may say, oh man, we just got a whole bunch of money in. Let's lower our rates and let's offer more products to lend this money out. But then when they run out of money and no one's making deposits, their loans might become way more expensive because they don't have as much money to lend. And they see these big fluctuations like 7-Eleven would versus a Costco that just has a huge store. They can sell the same thing. So that's a great analogy and way to put it. I think a lot of people listening probably have no idea how the mortgage industry works. And then as we mentioned, the portfolio lenders are best for people who can't make it work conventionally or traditionally, I should say, in this case, because conventional can mean more than one thing. So you go there.
And portfolio lenders will typically include private money, hard money as well, right? So those are lenders that are just lending on their own guidelines. They're too risky to sell to anybody else, right? It's just a guy giving you a loan because he likes you. Those would technically fall under portfolio lenders because they're holding them on their portfolio.
All right. Well, thank you for sharing your knowledge with us today, Christian. For people that want to get a hold of you and talk more about loans or possibly originate one with you, where would they go?
Yeah, theonebrokerage.com. Super straightforward. Our website. My email is christian@theonebrokerage.com. And I am searchable on all social medias as The One Broker, _ between the words, The One Broker.
You can also follow me online at DavidGreen24. And you can catch Christian and I together at many events. So go to davidgreen24.com and check out what I have going on, because there's a good chance that Christian will be there with his big brain spreading knowledge amongst the masses like Johnny Appleseed. Thanks for being here, my man. I appreciate you. We will catch you guys on the next episode of Mortgage Monday. If you've got a minute, go ahead and search YouTube for BiggerPockets and watch some more videos. And let us know in the comments what you thought of today's show and what you'd like to hear more shows being done on.